So good evening, everyone. Before we start, I'd like to draw your attention to the disclaimer on screen, which I'll read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorized to provide recommendations on any instrument of any kind as part of this presentation. The strategies showcased are applied on hypothetical scenarios. Any instruments that are mentioned throughout are cited only for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone doesn't represent that the material provided here is accurate, current, or complete, and therefore shouldn't be relied upon as such. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product, or instrument, or to participate in any particular trading strategy. We advise any listeners of this content to seek their own advice. So thanks for listening to that. So welcome everyone to our tonight's Master the Trade webinar, the 8th in the series. Please feel free as always to put your questions on the chat the minute you have them, and we will answer as many as we can before the end of the presentation. Now, as you can see on screen, we're going to follow a slightly different structure tonight than in previous webinars that we've run. Tonight's session is split into two, as you can see on your screen: professional trading education and real-time education. This is to help attendees to best maximize their time depending on their preference of what they want to watch and what they've got time to watch. So in the first 45 minutes tonight, Maurice Pommer is going to start, and he's going to discuss the impact of Brexit deal or a possible Brexit deal on UK assets. He's then going to hand over to Richard Adcock, who is going to discuss how you can use moving averages in your technical analysis for idea generation. This section will then finish with Roger Hawes explaining how to trade unscheduled headlines, like the Pfizer announcement that we saw last week. Then there will be questions. At the end of those questions, then we will move on to the real-time education and Q&A, where Maurice and Richard will give their assessment of where the markets are right now and then looking forward. So on that, welcome everyone, and I'll hand over to Maurice. Maurice, over to you.
Hey Chris, thanks very much, and welcome back everybody. Hope you're enjoying this journey through these courses. I think one of the things I want to touch on is something that I've been following very closely recently, which is about the UK, and this is sort of the underperformance that the UK has had since the referendum. Understandably, a lot of money left the UK when the referendum went towards a Brexit, and you know what's happened here is that we've been sort of seeing this sort of lack of investment for some time, which suggests that if things can turn around, we may see some value. So what we've got here is the underperformance in UK assets, one of those being the FTSE, whether we're looking at the FTSE 100 or the 350, whatever, but UK assets have been unloved, as you can see in this chart, for some time. And I think realistically, you know, things could change. If we look at it, the outperformance of the S&P on the other side of the chart there, you can see how far behind we are. And obviously the US has quite a lot of tech in there as well, which we don't have in some of ours. But you can see the marked difference there. And I think what we need to ask ourselves as markets look forward, where do we go next with this? So there is a danger here that, you know, we've got a potential vaccine coming in, which would be a very good positive. Hancock's talking about possibly distributing to those that need it most in December, and by December, who knows, we could have a Brexit deal as well. So I think what we want to look at is that, you know, we've seen a certain amount of resilience in sterling as well. So with all this risk in front of us, you know, sterling had been quite weak, but if we look at these charts now, you can see we've seen quite a bit of resilience from sterling since, well, July really. Some of this is against the dollar, obviously, which has been weakening just recently, but also against the euro. In fact, that chart to me looks like it's possibly even trending down. So euro sterling has pushed down again now. And I think that this sterling strength that we're seeing is possibly foreign buyers starting to sort of nibble at UK assets and putting some of this stuff on the portfolio as a risk reward trade where, you know, if it does happen, then, you know, there should be more money flooding into UK assets, and therefore sterling would have to be bought to buy those assets. So for me, this is quite an interesting scenario here. We're not there yet, and so I don't think this is a guaranteed trade by any means. And you know, there still seems to be some real differences between the UK and the EU on the trade deal. But you know, Boris has moved quite a few times away from what he said were deadlines, which makes me think he definitely wants a deal. So, you know, if we look at some of the seesaw headlines we've seen, and, you know, we see these dropping down on the left, Brexit talks could last another 2 weeks. We've got all sorts of chat about deadlines being broken. We're talking about, you know, people saying we're moving closer to a deal now. On the other side, we do get these sort of EU sources saying they're still wide apart. So I think what we're sort of sitting on here is a very close to possible deal or no deal arriving, and opinions are split on that. Even some within the Tory party feel a weak deal would be worse than no deal, but I'm not sure about that. I think having moved through these deadlines, I think it proves to me at least that Boris does want to get something done if he possibly can, and I think both parties need it, to be honest. So I think the points to consider right now are coming up in front of you on the screen now, and I think we'll waiting for more comments. There is a possibility we might hear something on Friday. There's talk that Barnier may sort of actually be talking to the EU on this, but we could be very close. The talk seems to be that we are getting close. So for me, both sides need a deal. I do worry that the year-end deadline could also be a red herring. Just like the deadline was on the 15th of October, that we were not going to go past, and of course we did, which it is a concern because the EU will keep talking, and they'll keep talking forever if they have to, because that keeps the status quo, which is what they want. So Johnson's going to have to make a decision soon, either to give up on some of these red lines or walk away. For me, I think it makes a lot of sense for them to take something, and then maybe sort of have an implementation period to sort of fight and battle out a few more of the issues. So we might get a light deal before the end of the year. And I think that makes a certain amount of sense. And it would be typical of the EU to take a fudge like this, which is what they do. Wait to the 11th hour, come up with some weak compromise, and then keep talking afterwards. So, you know, I think we're getting close to a decision being made. I'm hoping it's going to be in the positive. If that does happen, I do see you know, some of this capital flowing into the UK, looking for assets that do look cheap on a global stage, where we see overvaluations in many countries. And I think the UK would be, you know, pretty decent bet for an awful lot of asset managers, and that real money capital could support sterling as well. And I think what we could see from that is something we've spoken to you about recently, is about a potential W-shaped recovery. So we saw the leg down, which was pretty stark when we had the lockdowns in March and April, down that side of the W. We've had a small pullback as we've unlocked and gone back in. We're now looking at further lockdowns, so we're sort of looking at a poor fourth quarter now. But into next year, if we get this vaccine done and we get the Brexit deal, trade deal done in some form, we could see the back end leg of that W coming back there. And that's a really nice graphic there that explains what we were talking to you last week about a potential W-shaped recovery. And I think that's really interesting going forward. I'm going to be keeping a close eye on this a lot, and all the headlines are going to be important. I think we may get more out this week, and there's even talk of a potential shake of the hands and a deal next week. So we need to be aware of this. And of course, it's not done yet either. So, you know, some of the outcomes for markets are worth looking at, because it's not a guarantee that we're going to get this. So, you know, we have to look at the risks on the other side of this. But what I'm saying here is that I think some of the fund managers see that risk against the potential reward worth taking. I mean, obviously they're not going all in until they get any news, but I think, you know, a percentage of somebody's portfolio, I think, is beginning to think the UK may be attractive over the next 2 to 3 years. And don't forget, these guys are not looking for a quick profit early next year. These guys are investing for 5-10 years. So I think on that basis, looking forward, sterling assets do look cheap, and I think that's why we're seeing some resilience in sterling. So there in front of you to look at are some of the if they can secure a deal against if they can't secure a deal. And I think we have to be careful what does come out. And so there's going to be a little bit of volatility in sterling over the next few days. So I would be a little careful. But interestingly, sterling strength is holding up pretty well amongst all this uncertainty. So I think there's a lot to bear in mind on this. We've got some great dates for you down the left-hand side here. Take a look at those. There is that date on Friday. Barnier is set to brief European diplomats on progress on Friday, potentially. We're still waiting to hear whether they're still going to go ahead with that, but I think that's going to be quite an interesting statement to see how far they are getting on there. So, you know, whether they're going to make a major announcement, but I think the update would be maybe hopefully we're close. We are looking for some kind of concession on fishing, which is such a small part of the UK GDP that it'd be mad to walk away on the basis of just not agreeing over fishing. I hope they don't. If they do, they will need locking up, in my view. Right, so that is a quick look at where we are with Brexit, and I think we are going to have some quite difficult times. And so, you know, don't forget your technicals in this. I think timing some of these trades is going to be really important. I certainly use moving averages when I'm looking at trading as well. So I'm going to pass you over to the man who knows much more than I do about it, Richard Adcock. Good night. Good evening, Richard.
Good evening, Mo. Thanks very much. Good evening, everybody. Hope you've had a good week so far. Tonight, I'd like to sort of move on to look at another trending indicator, I think you'd classify it as, and that's moving averages, and specifically looking at using moving averages for idea generation in terms of confirming trends, giving you a timing to actually enter those trends, and then finally towards the end, just to highlight how we can use moving averages as a trading strategy, and also to help us with stop placement and to look at where risks may be beginning to turn to reverse the trend that perhaps we've been positioned for. So let's start with the basics first. And there are various types of moving averages. The simple and exponential are the best known. The simple is basically just where in this case, we're looking at a 20-day moving average, which is the blue line on the chart. And that simply just adds up the last closing levels for the last 20 days and divides by 20. So effectively, what we're seeing is a smoothing out of price action and plotting the 20-day trend. So as the average is falling, then the 20-day trend for the S&P index is declining, while a turn up within the moving average will show that the index is trading within a positive trend. And as long as that moving average continues to move higher, then the uptrend is in place. We can see that support will be found from a moving average. So effectively, prices correct and find support from the moving average and then extend a positive trend. So we can look at this as a support area within an uptrend or a resistance within a downtrend. And we can use that to establish the trending risk. However, one problem with moving averages is that when we're caught within a sideways trading range, they're less reliable. They can give more choppy, difficult signals to follow and effectively whip us in terms of positioning. So, and because a moving average is calculated in the way that it is lagging. So prices have to move a moving average. And so we will see a lagging factor within prices needing to rally strongly to see the moving average turn up. Now, one way we can overcome this is to use an exponential moving average. Now, the calculation is slightly different in that this places the emphasis on the latest data. So in other words, we start to see the exponential moving average following price action more closely. So on this chart, we have the S&P index again on a daily basis. The blue line is the simple 20-day moving average that we were looking at before, but the red line is the 20-day exponential moving average. So effectively what it does is to see earlier turns and follow price action more closely than the simple calculation. So basically, we will see earlier signals generated to a certain extent within the exponential moving average. And you'll find that a number of indicators which are moving average based, such as the MACD, which we've already looked at, will use exponential moving averages because they give slightly earlier signals and try and overcome the lagging condition that we see on a consistent basis with simple moving averages. So you can see the difference between the red and the blue line. The exponential will react more quickly to price action and follow price action more quickly than the slower simple. So what I want to look at now is the types of signals that we look at with various moving averages. So again, we're looking at a 20-day moving average, but this time the red line is a 10-day moving average. So they're both simple moving averages, red line being 10, the blue line being the 20-day. And you can see again that the slower base 10-day moving average follows price action more closely than the longer term 20-day. Now, the types of signals that we look for, there are really only two signals that you need to monitor within moving averages. The first is the bearish signal, which is called a dead cross. Now, this is where the falling short-term moving average crosses below the falling longer term. So in this case, the 10-day moving average falling below the falling 20-day moving average. And effectively what this does is to confirm that the market is trading within a bearish trend. So if you see a dead cross within two moving averages, it's a negative signal. It confirms that the market is trading within a downtrend, and the risk is that the market will continue to extend that trend. The next signal is called the golden cross, which is the bullish signal. And this is where a rising short-term average crosses above a rising longer-term average. So in other words, the red line in this example crosses above, while it's rising, above the rising 20-day moving average, the blue line. And effectively, this gives us the bullish signal to highlight the risk of the market extending higher within its positive trend. The only other signal that you can look for with moving averages is a neutral cross. And this basically, to be perfectly honest, doesn't really say a great deal, apart from it's the short term crossing above the longer term, but they're not moving in the same direction. So in other words, the 10-day in these examples is rising and breaks above what is still a falling 20-day moving average. Now, this in itself isn't a signal. It doesn't generate any confirmation of trend, but once we start to see the moving averages both rising, then that is confirmation of the ongoing positive trend. So again, it's a lagging type indicator, and we need to be aware of this when we're using moving averages. The lagging factor can give us some really slow signals. And I tend to use moving averages in this way more as a confirmation of signals that we should have seen generated elsewhere from Bollinger Bands, MACDs, momentum, and so on and so forth. So it adds weight to the current argument, and it gives you extra confidence within your positioning. Certainly if you start to see a dead cross and you're short of the market, it allows you to develop your negative themes. Now, there is one way that I do use moving averages, either as a idea generation in terms of a trading strategy, or to monitor my ongoing positions that have been established within other indicators or within other techniques. And this basically combines two moving averages again, but they're much shorter term. So I combine a 3 and an 8 period moving average. So on this example, we're looking at a 4-hourly chart. So when we talk about a 3 period moving average, we're talking about 3 4-hour sections. So effectively the close of that 4-hour period is added up and divided by 3. And the same for the 8 period. Now the idea generation comes from a trading perspective in that it allows you to see when the market is set to trade in a positive trend, or the risks are that the market's trading in a positive trend. So very simply, every time the 3-period moving average crosses above the 8-period moving average, and they don't have to be moving in the same direction in this case, we see a positive signal. So effectively, it's a signal to say the market's now trading in a positive trend. The risk is to extend higher and see a more extended move to the upside. Now, we would run that long position until we start to see both moving averages, or the shorter term moving average, crossing below the longer term moving average and saying that we're now in a bearish trend. So in other words, if we follow this as a trading strategy, it's a stop reverse. You've always effectively got a position in terms of, if the market sees the moving averages turn, then that generates a signal. It's when they turn again that sees a reversal of that position. So effectively, you're monitoring the market the whole time and you're reacting to the crosses within the moving average. However, one other way to use this is to generate stop signals, in that if you have a long position for whatever reason, whether you're based on sort of fundamental or technical reasons, you're long of a market, but you're unsure where your stop level should be, one way we could look at this in terms of running the stop is when the moving averages start to turn lower. So if we're trading in a positive trend and we're long of the market, if you suddenly start to see the 3-period moving average crossing below the 8-period, then that effectively says that you should stop your position out, because the risk is we're going into a more extended correction trade. Now, it may well be that we will see short-term signals which actually don't work, but we need to be aware of that risk. But again, you would see a fairly swift resumption to the upside. So in other words, the 2 moving averages would cross again to suggest that this correction is ending and you need to reverse this short, potentially take a loss on that position, but then look to extend higher within a positive trend and take advantage of that new signal and development of positive themes. So moving averages can be very useful. They can help you generate trade ideas. They can allow you to see when your stop should be activated, and they can also confirm ongoing trending conditions and signals and positions that you already have in the market. But you do need to be aware that that lagging aspect can be frustrating and can often give you quite late signals in place. So that's how I use moving averages. I'm just going to hand across to Roger now, who's going to look at trading unscheduled headlines, which these days is becoming increasingly important. Thanks very much, Roger.
Thanks, Richard, and good evening, everybody. So yeah, it's trading unscheduled headlines. So from a perspective of what are they, clearly, we have scheduled events, we have our calendar, we can see when data is coming out, and all these things are things that we can plan for. But these unscheduled headlines are things that come out of the blue, can happen at any time of the day, outside of our time zone, and then clearly they're things that can catch us in terms of our view on the market and the risk that we're holding. So just briefly, what can they be? Well, they can be as simple as tweets from presidents and politician remarks, all sorts of things like that. But they can actually go all the way across to big global events that really are frightening when it comes to trading markets, but clearly massive impacts on life and society, such as 9/11. And when those events come out, from a perspective of a trader, that's when you really need to be understanding the magnitude of what's going on, and risk actually should not be your primary concern in those markets. Just to give you a bit of background, in a trading room, when that type of event happens, we as market makers were literally just taking risk off of our customers and trying to put it back into the market as quickly as we can. We weren't looking to make money. It was a day where the market was just literally unwinding and de-risking itself. So those events, those big events are, yes, you can look at them as opportunity, but the market in itself is actually trying to de-risk as quickly as possible. So you've got to be very aware of where the market sits at that time in terms of risk. So if we, what we're actually, as Chris said early on, we're going to look at the situation where recently we had the very positive news about viruses, and there's been a subsequent one since as well. And firstly, just from those two incidents, quite interesting, you'll note that, you know, the first one was a real surprise, and we saw some big reactions, and the second one came out equally as positive, but the reaction not quite so much. And I think that tells you something as well, and that's something that we should all become aware of in terms of where some of the moves happen and why maybe we don't get the reactions sometimes. So one of the key things we need to do when we get these announcements, firstly, you know, work out whether you think it's going to have a global impact on the market, whether it's specifically regional, or it may actually be product specific. And by immediately analyzing that, we can work out what we've got to look into as to how we go about trading, de-risking, or actually, you know, using it as an opportunity. So one of the first things we must always look at is the credibility of this announcement. You know, is it current? It could actually be a repeat of something that happened earlier in the day, because we're not always talking about, you know, massive moves coming from some of these unscheduled events, but they are important and they are opportunities, and they can affect the risk that you have. So, you know, always be aware of what's gone on before. Be aware of what's in the marketplace. There may actually be some rumblings undercurrents of such news, and that may also affect what happens in the marketplace and the reaction to such news. So that's the other key thing you need to do. Once you've established in your mind this is a credible announcement, it's something I need to respond to, you need to work out in your head what could happen and what should happen. And in that respect, there's three things that you really need to look at, and this will help you gain control right at the very start. So clearly, what could happen? Well, the first thing is, what product could it happen to? And if you've obviously got a global event, a global announcement, or something of a huge order of magnitude, it will affect pretty much everything in the marketplace. And therefore your attention is pretty broad. If it's been a regional comment, you know, then clearly maybe you could be looking at maybe just the USA, or if we got a Brexit conversation going on, or an unscheduled announcement that's come out, really it's just going to impact EU and the UK. Or you may get you know, a pretty big announcement, by example, about oil, so it may just be product specific. Now clearly it will have some knock-on effect into the marketplace, because they are pretty much interlinked, but you know, your main focus would be on that specific product. And then once you've got the product, clearly what is the direction? You know, how is this going to impact it from a directional perspective? And the next one is, what is the magnitude of move that I would expect? And again, that will be your own interpretation. And your interpretation will come from how you feel the market was positioned. If you feel we've got a very positive event for the marketplace, but you feel the market's been very short and not expecting this announcement at all, then clearly that could increase the magnitude of the move. If you feel maybe the market's already started discounting some sort of event like this, but they clearly weren't going to get the timing right, it may have slightly less of an impact. So you've always got to have this in the back of your mind in terms of what you expect the market to do. And then clearly, we have to relate that to our position. And again, over time, as you get experienced, all these conversations that you're having with yourself, this interpretation of this news will happen quicker and quicker, because you clearly need to get on to assessing your risk and the impact it will have on the risk pretty quickly to be able to either take advantage of it or protect yourself. So if you have got risk on, the first thing you're going to be doing is looking at your orders. Are they still valid? Some may already have been executed. If they haven't been executed, can I move them? Should I move them? Or does this create the opportunity I've been looking for to take my profit? Or I do still believe they're at the right level in terms of protection, and therefore I'm comfortable with them. But all this needs to be assessed, and we need to be quick about it. And then clearly, does this change my view or reinforce it? Because then we get into that situation. If it's completely changed my view, I want out now. If it's reinforcing it, do I have the ability, albeit markets will be fairly illiquid, do I have the ability to increase my risk in the marketplace because I've got another positive plus sign in terms of the ideas that I have, and this reinforces me and forces me or makes me want to go and increase my risk in the marketplace. And then, of course, at the end, if through all this you're perusing that news and you're interpreting it and you have no risk on, there may be an opportunity, if you are square, to put some risk on and take advantage of any of these moves. But bear in mind, liquidity will be pretty poor, and it won't quite be as easy as you think. One other key pointer, please try and avoid trading rumors. That's where we talk about analyzing the credibility of something. Take that little bit of time to understand the source, and certainly with social media around, just be aware of jumping on the back of lots of rumors that actually come about in the marketplace. So the next key thing in terms of when we're actually reviewing this piece of news is how relevant is it and how impactful, and how can we give you these tools to help you in that process. And this is something that Mo puts together, and it kind of gives us the hot zone, the warm zone, and at some point things will start transitioning from the amber there, on its way towards that red zone on the left hand side. And anything that's sitting there in the amber zone, we really should have already done some reading, and we should be aware of it, and that will make it a lot easier to interpret the impact and the relevance of any of these statements if they do come out in an unscheduled manner. And clearly, what we're going to talk about tonight and focus is the vaccine announcements, and that would have already been in that warm headline zone. And so by transitioning across, we should already have a decent amount of information to be able to analyze whether this headline is something we really should be trading on. So that's very, very important to understand and have that prior knowledge of what really is bubbling under the marketplace. So if we quickly look at the move that we saw, clearly on any unscheduled event, it's a surprise. Markets don't like surprises, and you're going to see pretty extreme moves. In this instance, Pfizer announced their virus, that their vaccine is 90% effective in their trials, and the S&P jumped 2.8% in the first 15 minutes and then continued to rally another 0.5% over the next 2 hours. Now, clearly there's opportunity there, but if you've got risk in the marketplace, that type of move may have stopped you out. You may have been sitting there short thinking these vaccines are not coming. You've got a little bit of risk off. You think we're going into lockdowns everywhere. There could have been every good reason for you to have been playing the short side of S&P. So the surprise comes out and you may well have been stopped out. You could have also fortuitously have taken profit if you'd have been long, and this jump might have fallen into your hands. The key thing for me here, as I put in the right-hand box, in both instances, whether you're taking profit or whether you've been stopped out, don't get lazy. Keep analyzing. If you've fortuitously taken profit, there may be an opportunity to get back into that trade and get yourself long again and grab another 1% if you're fast enough, if your interpretation is that this move could go a lot further. There's nothing wrong with taking that profit, but don't get lazy. Take a 1% profit on this move and watch it go another 2.3% up to its highs. So we got to stay on the ball even in that instance if we've taken profit. And if we've taken a loss because we had our stop loss in the position that we wanted, again, don't get lazy. Analyze this, and if you think this is very, very positive news for the product that you're in, and in this case S&P, you may have that opportunity to jump on the long side of the trade. And let's say you've lost 1% on your short position, you may be able to recoup that pretty quickly. So key factor there, don't get lazy if your orders are executed. There's still opportunity there. Now, one of the things I just want to touch on here, and I'm just going to go into it very, very briefly. It's an in-depth subject, way complicated. We all know these algo traders are around, these high-frequency traders. And I just wanted to highlight here some of the things as to why they're so deeply involved, and certainly so deeply involved in the early part of the price action. And I'm not talking here about these complex execution algorithms that people set in the marketplace to sell X number of units over a period of time, etc. I'm really talking about the high frequency guys that classify themselves as price makers and that are involved in that early response. So they will respond to the price action or the headline in nanoseconds, far quicker than any human being. If there's scheduled data or press releases, they will have predetermined responses in dependent on the level of surprise. But clearly, these are unscheduled events. So they're not trading off the back of that. They'll be trading off the back of price action. And an algorithm will respond by submitting and cancelling multiple orders based on the probability of the next tick going up or down. And clearly, if these ticks, the probability is that they're going to keep going up, as in this S&P, they will exaggerate the moves initially when momentum will clearly be skewed one way. Now, the one thing that may happen is that they are ambivalent to the news that comes out. So they could potentially move the market the wrong way if a little bit of price action does tend to go the other way. So don't always think they're 100% right and there's someone to follow, but just understand the impact they have on those early pieces of price action. And then when I relate that to the market, because these machines are trading in nanoseconds, lots of people, the human eye will think this first wave is impossible to trade on, and it looks like a gap. Well, actually, if you do the analysis, every nano tick or whatever is actually traded by these machines. So it's invariably impossible for the human to jump in very quickly. So just a little background on why these machines have an impact, and certainly when a piece of news is going to spark some severe price action. So we're going to go back to the S&P, and here we can break it down a little bit more for you and maybe help you understand and accept that you're not always going to be able to participate in every piece of the marketplace. And what you see here, we've broken each one of these candles is a 5-minute window, and you'll see that very quick reaction, and that will be the headline hits, the algos react, and also mixed in amongst there will probably be some stop loss orders that are hitting the system. And they would just keep refueling the algos and that level of probability that the market's going to keep going higher. And then we'll have like a second wave. And this is the opportunity for us mere mortals to participate in the market. And obviously, that overlap that you'll see, there's a small overlap there, you know, your ability to participate either in the back end of that first wave or certainly the early part of the second wave will be down to your own speed of thought, your analysis, your understanding of the markets already. So that's all that preparation that Morris talks to you about, understanding all those fundamentals, understanding that some of these may also kick in some nice triggers on the technical analysis as well. So it's all that preparation we're asking you to get involved in. This is where it really starts helping us. And so the quicker you can understand and interpret this, and the more decisive you are, the earlier you can participate in certainly wave 2 and possibly the back end of wave 1. And then obviously that decisiveness, part of it is your gut feel. You know, remember when I said to you in the first couple of sessions, never wait for 100% of the information. Use your gut feel to press that button, kind of deal or no deal. If you get into that trade when you got 75% of the information, you know, you're going to be in a much better position. You may call a couple wrong. You may get into something that if a little bit of analysis suggests no, but I'd rather be the one that's getting stuck in there with a bit of decisiveness and trying to make some money out of it. And then we've got wave 3. Now, you know, if you're not quick enough and decisive enough in wave 2, you're probably gonna struggle a little bit, because now you start getting into, certainly in this one here, and we'll see in another couple of products, things start flattening out a bit. There's a little bit of questioning. And if you have got your position on in those earlier waves, this is the time where you get a little bit more time to breathe, reassess, and then execute further or adjust your stop losses. Because this is where the market's digested it. The algos have done their piece. People have got in, stop losses have been had, and now you're going to start to see further waves of investors either coming in, or people that jumped in early want to take profit, and you may sometimes see reversals. And each market will respond differently. But these are the questions you now start asking if you have got that risk on. You know, do I think it will continue? Where am I looking to take my profits and run? What is my response if there is a reversal? So you're looking to get ahead of yourself again. Remember, plan your trade, trade your plan. So that third wave is where you start asking yourself questions, digging a bit deeper into the detail, and finding out whether you think this is something that can continue, or you can just take a quick profit if you've got on the right side of it in that second wave. So, you know, hopefully that gives you an idea of how to trade them and really what's happening within those early moves. I've just put these 4 other charts up here, exactly the same time period, all 5-minute bars, and just to show you that things will respond differently. And just a very quick analysis, and this is just me viewing these charts and giving a quick interpretation without really digging into the news. If I was just to look at that oil chart, now clearly people saw that as a nice positive to global trade moving, you know, growing again, more use of oil reserves, etc., oil price going up, and you see that immediate reaction. But then you actually see a leveling off, and for me, I look at that and I see that leveling off just above the 40 mark. Now, for me, I always look around the phobia, and 40 clearly was a nice little level. And you know, the thing that oil is physical means there'll be more hedges out there, and maybe lots of people were sitting there thinking above 40 I'll start hedging, and that's why you get a bit of a plateau. Different product. If you look to the right on gold much more illiquid than most of the other products we are looking at, and really you see it go down in pretty much a straight line. Very few reversals, and that for me was a liquidity thing. People thinking, oh, I've got to get out of my long gold position. It's no longer a safe haven because the world's looking better. I don't need this gold hedge against the world as such. And so you see a constant line straight down, pretty much no reversals. And again, just a trait of the product. And these are the things, if you're understanding and trading in these, you should understand the different characteristics of each. If you look top left at the Aussie, you get that instant reaction to this positive risk on. We know Aussie highly correlated to risk on, so you get that big move, that first move overextended, very, very big, and then it starts getting choppy. And firstly, I think that's pretty much like currencies. Currencies can get choppy. There's lots and lots of more participants in currency markets, really. And you got many buyers and sellers once you see that immediate reaction. And potentially, that suggested that, lots of people were short of Aussie, hence that first jump. But actually, I think you can see, despite the fact it's positive news, I think if I recall, at the time Aussie was under a bit of pressure, and you may see people actually doing that analysis. That first and second wave was on, and the reassessment and analysis in wave 3, they may actually feel, yes, this is positive, but I actually still want to be short of Aussie. And they may not be short of Aussie versus the dollar. They may be short of Aussie and crossing it out, as we said the other day, against the euro or something like that. But overridingly, this suggests to me that whilst the good news came in, they still reverted to the fact that they thought Aussie was still one of the weaker currencies out there. And then if I look across at the euro sterling, well, other things on the agenda here in terms of Brexit. You saw a sell-off in the euro and some purchasing of sterling. I think being a cross currency, this one probably took a backdrop. It probably changed direction a little bit, but what you're seeing there is more the impact of sterling strength that Mo's been talking about that really overrid the vaccine news. Vaccines positive was probably fairly neutral for Europe as well as for sterling, and what you're seeing there is actually the Brexit story coming into that chart. And again, as a cross currency, lower volatility. So hopefully you see there are different reactions to it, and part of our job as traders is to understand the responses to each of those different markets. So just to very, very briefly recap, and one of the things, unscheduled events will heighten our emotions. It's uncertainty. We weren't expecting it. Something new we got to factor quickly into our risk. So, for me, controlling those emotions is all about understanding what's going on, and hopefully we've helped tonight. Understand the algos will dominate the initial market response, so don't get frustrated if you can't get in on that first piece of price action. You've got that ability to participate, and your ability depends on how decisive you are and how aware you are of the subject matter that's come up. Adapt your own response. If you don't believe it's good and you want to fly in the face of it, you can fade some of these moves. I would suggest you fade them, from a position perspective, in small pieces. But not everybody will interpret things the same way. But as long as you have your process and you stick to that process, then I think you'll stay in control and you'll keep your emotions down. And also remember, if you're not the type of person that feels they should get involved in these markets, it just doesn't suit your style, this smash and grab. If you are the kind of person that needs to take a little bit more time understanding what's going, then don't participate in those early moves. Wait for the markets to settle and then start really analyzing the way you do if you're that type of trader, and put your trade on afterwards. Key one there, as I said, don't chase every headline because you will get plenty of reversals. I remember we had one way back, where I think it was Mnuchin came out and said something very positive about trade, sorry, negative about trade, US trade, and with China. And, you know, within 20 minutes, I think President Trump had tweeted to completely reverse the move. So jumping on every single headline can sometimes tie you up in knots as well, and you'll get some fatigue with it as well. And the other key thing, and you do see me or hear me talking about this as well, when these unscheduled events happen, it's what I call in-flight order management. You know, you put a position on instinctive, you don't get time to load up your stop loss, to load up your take profit. You're kind of flying the market, and your order management will purely be by instinct. So make sure you still keep that discipline, you know, in your mind, even though you may not have been able to get your stop loss in at 40. If the market goes down through 40, keep that discipline, stop yourself out. Similarly, if you think you should be taking profit up there at 80 and the market rallies to 80, unless anything more obvious comes out, take your profit. Don't get greedy. Trade that plan, even though you haven't got the markets, the orders in the system. And that, it's a lot harder. It's a lot harder to do, to keep your discipline when orders aren't in the system. So it's something to really bear in mind and make sure that discipline is there. So I think that's me for this evening, and I'll hand you back to Chris for some mid-webinar questions, I think.
Great, thanks, Roger. While I've got you on, and this could be open to the other mentors as well, but somebody was asking that, is there any asset that's noticeably or always reacts to unscheduled announcements in the news, e.g., you know, gold or currencies? Is there something that's really reactive?
Mo's probably a bit closer to markets than me, but I would say it depends on the sentiment within the market and the themes that are going on. My guess is that you'll probably feel there's a more instant reaction in the more illiquid ones, because, you know, someone jumps on and the algos can potentially take those a bit quicker, but they may reverse quicker. I'm not personally aware of a product that will respond to every single unscheduled event that will come out. I think most of them will be, as I say, global, regional, or product.
I was going to say probably the biggest
related.
one maybe is the dollar, because it's involved in everything.
Yeah,
that would be the broadest spectrum, right? Of if there's a negative headline, then usually maybe the dollar takes will tick up, or vice versa. But certainly,
Chris, but again, it will be in various degrees, because the dollar's connected to everything, to oil, to gold, so it will still respond in various degrees. The fact that the dollar's linked into all those,
I think
Mo, you got something there?
Yeah, personally, I think Roger's absolutely right, but I think it depends what the news is. So basically, if the news is a global recovery positive, then things like the Aussie will always probably do quite well in the middle of that. And you will see the dollar probably move down against a few. We often see sterling move a little quicker than the euro in those movements as well. So you can be a little bit selective against the dollar, but generally when it's something as big as that Pfizer comment or 9/11 or something like that, all markets will move. And basically, I think you tend to trade after a little bit of experience, the markets you're used to or more comfortable in, or the ones that have made you money in the past. But I think, you know, if it's a global growth story, then the risk assets like the Aussie, oil, and the dollar will be negative on good news. You know, and also it depends if, as Roger said, if it's something that's specifically bad for the US, like you know, the 9/11 issue, then obviously, you know, there's all sort of domestic issues there as well. But it depends what the news is, and depends how broad an impact it has on the global economy.
All right, great.
Sorry, Chris. One of the, if you look at let's say Lehman's, you know, on the announcement of Lehman's, you know, whilst people may have expected it, but maybe some people were expecting, you know, a last-minute government purchase or something of that ilk. You know, when the announcement came out, it was a shock, and what you saw was a massive unraveling of risk, because at that point in time, the market was flooded with risk, you know, credit, etc., etc. And once that happened, you know, certainly I was sitting there in the room trading currencies, and the first thing everybody flew into was yen and Swiss francs, because at that point in time, everybody was short of those two currencies as the funding currencies. Now, that's because, you know, and we had a massive response across all products, but that's because there was huge positioning in the markets. Sometimes you'll get other unscheduled events, okay, not on such a big scale, where there won't be such big market positioning in the marketplace. And that, for me, was where I mentioned factoring in how far you think the market should go, the order of magnitude of the move, and things like that will play a big part in it.
All right, great. Richard, one for you, or a couple of questions for you actually. On the on your stuff when you were talking about the moving averages, are the exponential moving averages better to use like 50 over 200 over 200?
Yeah, I think that's probably a fair comment, because basically the nature of the calculation, the longer term, the moving average calculation, i.e. 50 and 200, then obviously the longer it will take to move that moving average. So, you know, if you start to see exponential moving averages on sort of 50 and 200 day or period calculations, then the reaction will be quicker and probably more useful, because the shorter term averages are more volatile anyway. So there's less need, I guess, to have the exponential calculation. And as I said earlier, to be honest, with the shorter term view, exponentials really only tend to be used within calculations for moving averages. You will find that the majority of people will use a simple moving average, even knowing that it will have that lagging factor.
Great. And can you use 3 and 8 exponential moving averages? Can they be used on higher time frames than you highlighted in the presentation tonight, which was 4 hour?
Yeah, absolutely. I only used 4 hour because it was a nice example of the types of signals. You can use that on the same basis and same techniques within daily, longer term, or even shorter term. So the signals will, as long as you've got a trending market, which obviously is when moving averages work best, you will be able to use that technique on any time frame.
Great. Just the last one, maybe Maurice, probably best for you. Is there a service that explains essentially the way we've talked through, like the reaction of the S&P against on the Pfizer announcement? Is there a service that you can find out there, or an indicator that explains why that asset has moved in the way it did, you know, in that recent past?
I think you can probably have a look at things like the FT or Bloomberg. I think there's quite a lot of analysis in there the day after. Obviously, if you want an explanation, and rather than getting something on the spot at the minute, which is very hard for anybody to get that sort of information out in a timely fashion. But I think if you want explanation of some of these things, I think some of the sort of financial journals do exactly that. You know, if you're in a place where you can actually get bank research, obviously it's in there the next day. But I think and what you should do with this, once you've learned that, is keep it with you in case a similar sort of thing happens again. Not the same event, obviously, but you know, if there's a massive risk-off event, you'll know what to sort of expect in certain instruments. So I think it's worth reading up on these things after they've happened, whether you manage to trade them or not.
Okay, great. And one last one before we move on. On moving averages, Richard, do the classics like 20, 50 day, 200 apply in the same importance on lower time frames?
You will find that people sort of tweak the calculations and time frames of moving averages. To be perfectly honest, there's not a lot of difference between a 10-day and a 14-day. I've known people use 14-day and 26-day and swear that it gives you the best signal because they've back tested it. to be honest, it doesn't make a huge amount of difference if they're within a few periods of the calculation of each. So I don't think it makes a huge amount of difference, to be honest.
Okay, and on a day chart, a lot of traders are said to use the 50 and 200, but on a 15-minute chart, does a 200 moving average hold the same way, or is it too slow for a 15-minute moving average?
It doesn't hold the same weight, because basically the only reason, well, I'll say it's a bit facetious to say that, but the main reason why people use the 200-day moving average is that it effectively equates to the trading days of the year. And that's the reason why it sort of holds such significance within the longer term time frame, such as a 200-day. So it doesn't hold as much weight. To be honest, it always used to make me laugh when I sort of sat on a spot trading desk as a technical analyst, and these the traders would be sort of trading in split seconds almost, but they'd still want to know where the 200-day moving average is, because it would act as such an important pivot for the market, effectively for a short-term trade. If you broke the 200-day moving average, people would react to it. But because even though they were looking at things on an intraday basis, they would still be aware of the 200-day moving average and want to know where that level was.
All right, thank you very much, Richard. Right, well, on that note, we will move on to Morris for his real-time update.
Okay, thanks, Chris. Right, some interesting markets at the moment, everybody. So let's sort of get on with it right now. Where are we right now? Down the left-hand side, you'll see a list of a few things that I'm focusing on. A couple of pieces to pick out of here. The rotation of investment into Asia seems to be increasing. We're seeing some pretty big moves in Asia, so I think that capital flow into there is important. We saw US states introduce more restrictions after reports show biggest virus case increases. Keep an eye on this. This is a biggie for me. I think the US is unprepared to face this virus head on, as it should be treated, and I think this laissez-faire attitude towards this is going to be very costly for the US and could have impacts on the economy going forward. It's going to be interesting to see what sort of Thanksgiving we have and what they do with sort of potential lockdowns over Christmas or into next year. They're reluctant to do it, but I think they could be forced into this if we get hospitalizations, the capacity levels, if you like, rising further from here. So there's a list there. Take into all of those, because they're the things I'm looking at the moment. And down the right hand side, obviously Brexit talks rumble on. We've talked about that already. One thing I have picked out there in particular is that Poland and Hungary are blocking this EU budget, which contains the Euro aid package, which was voted on with some fanfare, which took the euro higher and bonds bonds higher as well, yields down. And I think them vetoing this, Poland is thinking about it. Hungary seems to be wanting to go ahead with. Don't forget, it only takes one of them to block the whole thing, and no fiscal package, no aid package, then no recovery. So I think this is an ongoing thing we need to keep an eye on. So look out for headlines on that. Could be euro sensitive. If we get something on a veto from Hungary, the EU aren't going to be happy with this at all, so they may try and throw some money at them to make it go away, as they often try and do. The other thing is we did see a very large trade deal signed amongst 15 Asian nations. The exception of that was India, and of course this keeps the US out of it, and the EU, to be honest, and the US out of the TPP as well, means that they're not in some of these big global packages, which I think is quite interesting. And some of the talk about how much this could actually add to the global economy is quite interesting. And I think those involved with it could do quite well, but I do think the major beneficiary there will be China, who could dominate that trade agreement and possibly even bully it at some point. But certainly South Korea should do fairly well out of it, as well as Japan. And Japan is seeing levels in the Nikkei that we haven't seen for quite a number of years. So there is money flowing out that way, and I think this is part of why that's continuing. I think we've got to look at the US election is probably behind us, but obviously the Senate is the issue. We've got a couple of dates there for you I think are worth highlighting. The big one for me is the January the 5th Senate runoff. That's going to be a big one. We are seeing volatility start to rise in that on the futures of the VIX. We're getting that hump that we had around the election, which created a lot of volatility around the election. That's beginning to come in at the beginning of January as well. So I think that sort of highlights roughly where we are. I'll take a little time to look at those. But we did have some rather disappointing retail sales data of the week. And now I spoke to a lot of people on Sunday night, you know, those that were able to attend that. You know, we were talking about the hit to consumer confidence on Friday in the University of Michigan confidence data. Now, my first thought on that was, well, what does that mean for retail sales that come out on Tuesday? And, you know, we saw these numbers come out yesterday and they weren't very good at all. This chart shows you the sort of drop back to almost zero. The control group was, you know, which feeds into GDP, was not good either. I think that was 0.1%. And there's two reasons for this. One is the psychological impact of virus hitting, you know, making forced restrictions, lockdowns in some cases, knocks the psychological impact, knocks the psyche of the consumer quite hard. Consumer confidence does sometimes move into sales, but also on the back of this is that the relief packages that supported everybody through that big spike red line down that you can see there, retail sales fell dramatically because nothing was open. The bounce back we saw was also helped by the fact that relief stimulus was given, aid packages were given to US people who had lost their jobs and quite a lot of people who were furloughed. Unfortunately, those programs are all finishing. Some of them finished in October, and some of them, including student loan help packages, are finishing on 31st of December. So, you know, we don't have a relief package at the moment. There's less money for these people to spend. There are huge queues in America. I'm not sure if you're aware of this, for food banks. So people are hurting, and I think we need to be careful about what the impact of this virus is going to have on the US economy. So I think we need to be careful here because, you know, the US is not immune to this just because they're not dealing with it. And I think that there's a danger that they are lagging the EU and they may find themselves in trouble going ahead. So I think we need to be very aware of that. So that brings me nicely into sort of looking forward to markets. And I think on the stock side of things, there's a few things that I'm looking forward and keeping a very close eye on the left-hand side of your screen there. Interestingly, out of this week came the Bank of America Fund Management Survey, which is always an interesting read, but it suggests that cash levels on deposit are dropping, suggesting funds are now very actively back in the equity markets and using that cash to sort of invest. So with those falling, it suggests that even at these dizzy heights, some of the fund managers seem to be going all in equities, which makes me worry a little bit. I mean, one of the things that I do worry about is how much good news have we had with the vaccine news that we've had. Is it already out? Yes, it's something for the future. Yes, markets look forward. What worries me is the gap in between when we actually get it in the size we need it and the damage that we could see from the lockdowns on the economy in between. So, you know, where are we on this? And I think it's really interesting point now with the disappointing retail sales as well coming through, that we need to be aware that there seems to me to be a sort of a bit of a diversification between what bond investors think, which is slightly negative, against the euphoria amongst investors in the equity space. So on the dollar side, on the currency side of things, the dollar remains under pressure. I think a lot of people are talking about the Fed expecting to have to step up in the absence of fiscal support. That's the government support, this virus relief package, if you like, which looks like it may be a lot less than originally thought. The Democrats, Pelosi, turned down 1.8 trillion offer from the Republicans under Mnuchin, and should be held to account for that. I mean, it was shocking to turn that down. They may get a lot less than that, especially if there's a split Senate and Congress. So, you know, this Senate battle is very important for things like this virus relief package. Dollar yen and dollar CNH, that's the China offshore currency, reacting to lower bond yields. This is This is people buying bonds. They're a little bit worried about the Fed coming in, or a little bit worried about the impact of the economy. It's a risk-off trade, really, which takes the yield on the bonds. That's like the interest rates on bonds down. Now, dollar yen has correlated itself very closely with US bonds. And so if you see US yields starting to fall, then dollar yen seems to be following it quite closely now. It's not following risk a great deal, it's following bonds. So we need to be careful of that. And this dollar CNH weakness, this is China currency strength. And this is what I was talking about before, and I've been talking about this to you for the last couple of weeks, is that there is foreign capital flow into China because the stock market is strong, they've got the forest behind them, and their economic growth is still actually going forward. They've had some decent data recently. So I think we need to be aware of that, and that could keep a cap on the dollar as well. The veto we've spoken about, and then of course Brexit we've talked about, and we are getting close to some kind of decision there. So there's a lot going on at the moment in the currency markets. The dollar is under pressure. I think dollar yen, if we do see lower bond yields, could start breaking out the previous lows we saw just above 103. I'm sure Richard's going to talk about yen and euro sterling as well, but I think some of these currencies could be breaking some pretty big levels shortly, and it looks like we could see a step down in the dollar across the board. But I think, for me, it's still advisable to be a little selective in some of this. But the market, I think, is quite interesting now. It's nice to have currencies back in the news and back having a little bit of volatility in them. And I think there's some intriguing moves coming up in currencies over the next few weeks and months. So events that matter for the rest of the week: the EU Leaders Summit, definitely something to consider. There is talk that there could be a mention from Barnier to the EU leaders on Friday as well, so keep that in mind. PBOC rate decision, I don't expect them to do a great deal, but it'd be interesting to see the language from that. And retail sales anywhere really is always important, and we saw it in the US. We've got Aussie retail sales that can certainly move the Aussie. We've got retail sales in the UK, an early release there at 7 o'clock in the morning GMT, but that can have an impact as well. So it'd be interesting to see how the UK consumers getting on with that, and then the Canadian one later as well. So UK PM Johnson to call EU von der Leyen again, and I think realistically these guys need to really start pushing this now, and I'm expecting something possibly early next week, one way or another. Hopefully we get something on a deal, but I think we could have an interesting week or two for currencies, which is all good for me. Then I think we're going to pass over to the back to Richard, who's going to talk about the technical setup for markets right now and the live markets. My favorite bit of the evening. I do love the live market updates, so I'm going to pass you straight over to Richard. Richard?
Great, thanks very much, Mo. I think certainly some of the points that Mo was raising there were extremely important, and I think have been sort of evident and filtering through the technical perspective as we've been sort of evolving trade this week. So if we just switch to the live setups, we can have a quick look at the current positions that we're holding for markets in terms of the technical setups and where we stand at the moment. So starting with the S&P on a weekly basis, I sort of mentioned last week about the possibility of last week's action maybe even forming a negative reversal, having rejected the new all-time highs. The fact that we closed having rallied on Friday meant that we didn't form a negative candlestick reversal pattern. So on balance, the overall evidence is still pointing towards higher levels, with the risk for further attempts to extend to the upside. And we'll look on the MACD and stochastics. The MACD is still above zero. It's just broken back above its moving average. So again, this is entering into a more aggressive, if you like, trending perspective, while momentum is still sort of moving higher. So the current setback that we're seeing this week is really sort of more of an indecision move, consolidation. It's an inside week. So far it's being held by the extremes of last week's range. and that basically sort of highlights consolidation, but no reversal as this at this stage. So effectively, sort of turning towards the daily view. Yes, we've seen a setback over the last sort of couple of days, and again, we're sort of seeing that materializing today, and we're sort of trading back towards the lows. But there's still no real negative activity or shape within technicals within latest price action. One thing I would point out is that you hear people talk about divergences quite a bit. Now, this is where price closes at new all-time highs, but indicators fail to confirm those new upside extremes. And you'll see that we've got a divergence within the daily momentum, within daily slow stochastics. So in other words, these new closing highs in price, so we're still below the intraday high, but on a closing basis, we made new highs. The momentum has failed to confirm that new upside extreme. Now, this would be a bit of a red flag warning of divergence and the risk of a more extended sell-off developing. A couple of points on this. Trending has still made a new high on this latest closing level. So for me, I need to see both momentum and trending giving divergences to reflect an upside failure. So obviously we haven't got that with trending. To confirm any divergence anyway, you would need to break last corrections lows. So these lows around about the 35.10 area would need to give way to really sort of suggest any significant deterioration or further deterioration within the market and bring about the risk of a more extended sell-off and retest of these recent lows. To the upside, it's still this high that's the important focus. We would need to break above that to resume a more significant upside move. But the technical backdrop still supports the upside risk developing. DAX, yes, we've seen a very strong rally. Yes, it's been very impressive in terms of price action over the last couple of weeks. Have we broken any significant technical levels? No, afraid not. The market is still struggling with these old highs. Bollinger Bands are still relatively tight, and no great trending condition in place. So we would still need to break these highs to really suggest risks of developing upside. And then we still have to come into play with the March highs and breaking above those to really develop more positive themes. So really equity markets still very much a US story. Still looking at the S&P as being the main driver. And while we're still sort of seeing more constructive pictures within the US at the moment, certainly breaks to new highs wouldn't do it any harm to develop the more positive themes. The interesting one for me in FX this week has been dollar yen. And Mo mentioned it earlier, but for me, it's still trading in a negative way. I mean, I was looking at this failure. I think you'll remember last week, we sort of highlighted this as a failure at retracement resistance, and the market has developed that by not only breaking below the mid-average, but also seeing momentum crossing lower within an ongoing downtrend. So the MACD is still below its zero line, it's still a downtrend. We've seen momentum cross lower around about this session here, which for me, at the same time as the mid-average gave way, was an indication of more negative themes developing again. And now the MACD started to break below its own moving average, below zero. So, the focus for me is still these lows just above the 103 level. That's, from a trading perspective, that would probably see the market consolidate, even recover. But if we certainly start to see those points give way, then it would risk a more extended sell-off. One other area where we've been seeing US dollar weakness is against the Kiwi, and the market continues to post new recovery highs. We're trading in a more positive trend. You can see that Bollinger Bands are starting to widen, reflecting positive volatility coming back into the market within an uptrend. This mid-average has held the support to the downside. You can see that we're now moving back towards these previous highs posted around about sort of late last year. Sort of, this is the weekly chart just to sort of put everything into perspective. So we're now testing these old highs, and this is a resistance focus, but I think the overall risk is that we can still, if we do start to break above these points and close above them, then you're still potentially up towards the 74-cent area as before hitting the next main resistance point. So for me, the themes of dollar weakness are still very evident, and cable has started to see more positive themes developing again, momentum crossing higher on a daily basis at the same time as we're in a positive trending condition reflected by the MACD. As you'll remember last week, momentum turning up in an uptrend suggests re-acceleration or extension of that positive trend. So again, the overall risk is still towards higher levels in cable as the dollar comes under further pressure. One slight exception still is euro dollar, in that it still looks reasonably constructive, but I've just left the price action. I haven't put any indicators on this because basically, it's still very clear that we need to establish and see closes above this 119 level, basically through these old highs, to really suggest that the market can push towards sort of higher levels, bringing back these old highs and even up to high as sort of 124 and just above that as the next main resistance. But you can see that this type of price action really isn't showing that much in terms of any sort of significant price movement. And if you put Bollinger Bands on the chart as well, it just sort of reflects the sideways trading range, the flat average, the parallel bands. There's no real aggressive movement coming into this. So, while I expect the dollar to come under increasing pressure and to continue the moves that we've seen, euro isn't really sort of reflecting or highlighting any significant outperformance risk of the dollar. So that if we're sort of cautious on the US dollar, then that remains that we have to be sort of cautious still on euro. And so we then start to look at euro crosses and where the potential sort of underperformance of the euro could be seen. It would suggest euro yen, euro kiwi, and euro sterling as well is quite interesting as it stands at the moment, in that we're still trading in this downtrend channel. Momentum's crossing lower again with the MACD below zero, so another re-acceleration of this downtrend. So, the bias is still towards lower levels within euro sterling. So effectively, really within G10 at the moment, from my perspective, it's still weakness evident within the US dollar. It's still sort of looking for the euro to come under further pressure, and really the likes of Kiwi, Stocky and Aussie really sort of still look to be the stronger performance technically within G10 at this stage. So that really seems to be the general setups that we have at the moment. So I think it's still very cautious on the US dollar and looking for that to develop those themes over the course of the coming days and into next week. So that's the technical viewpoint. I'll just hand back to Chris, who'll sort of handle all your next questions. Thanks very much, Chris.
Thank you very much, Richard. Thank you to all the mentors tonight, Mo, Richard and Roger. Some great content and obviously some fantastic questions from the attendees as well. So we just got a couple more questions that came in, unless there's people want to put some more on the chat. One for you, I guess, Richard, but maybe the others mentors want to talk about this as well. Do you feel it's more beneficial to focus on just G10 currencies when you're looking at equities to create an edge in the market, rather than focus on other products, when you're using technical analysis as well as fundamentals?
I've always found that it's perhaps more useful to stick to G10 because that's where the majority of the liquidity is. That's where you'll start to see the more significant movements coming through. That doesn't mean that I wouldn't necessarily sort of be looking elsewhere, like for gold, to sort of reflect some risk on, risk off themes. But for me, it always tends to be concentrated around the G10 currencies and how they react and likely sort of movements in terms of risk and how that's likely to evolve.
Maurice, do you have any thoughts on that?
I do. I think realistically, it depends on your level of professionalism and the amount of money that you're investing into this sort of area. I think if you are fairly well versed in emerging markets, they are a potential, but they're high risk. They're wide spreads, and they're very high margins, so they're costly to get into. So you need to do your homework before you entertain any of those sort of currencies. But you know, I'm with Richard. I'm inclined to sort of stick to G10. The problem with trading currencies against stocks is, well, why not trade the stocks? I mean, you're looking at a second derivative if you're trading a currency off something you believe in stocks. I'd rather trade the underlying myself. So, you know, the indices are pretty easy to trade. They're fairly liquid. You know, I think it depends what you're trying to achieve. But I think the EM space on a very selective basis is okay, but it's a dangerous place to trade, that's for sure.
Okay, and do you think, you know, there's a lot of banks have actually been talking about, you know, weaker dollar this year is to some degree, but also into next year as well. Do you think that that's a valid proposition? I know you've touched on that tonight.
I do. I think there's a very great chance of it. I think, you know, we see rotation within the US markets at the moment, but I think there's a danger there's a rotation out of US markets altogether. I think they're very high valuations. I think, you know, the Fed is still possibly, you know, some people think they're going to move again in December. I think that debases the dollar even further. And I think there is a chance that people are seeing better value elsewhere, and I think that could be a dollar negative well into next year, to be honest.
Okay, great. So one last question then, but for the minute, with Brexit, if we do, we've talked about it a bit tonight, if we do get this closer to a deal as you've been talking about, but we don't actually get the official yes, it's done, do you think that the markets sort of trend towards a more positive outlook on that because we're getting closer?
I think we are seeing that. And again, it comes down to this sort of investor looking forward risk reward type of situation where they're prepared to put a percentage on their books just in case, because the rewards could outweigh the risks if there's nothing, because they, you know, they're paid to take a certain amount of risk. But the other thing is that they're very it's crucial for them to sort of benchmark. So it's the big players that matter in all this. You know, me buying some stock somewhere is not going to make any difference to anybody. But when you have a massive fund manager sort of moving billions of dollars worth of stock, and he decides to start buying and nibbling away at UK assets, then he's got to buy sterling to do it if he's not onshore. And this is what I think we're seeing. So I think we're seeing exactly that. Yes. So good question.
Okay, and are economic cycles something to keep in mind whilst trading? And the example that the attendee was using was reflation.
I think that they're slightly different. I mean, economic cycles are, you know, in a globalized world, they're sort of more in step, but they are still relevant. The reflation story is a global one, really. So we're starting to see that from beginning with China, starting to reflate, and the markets are looking forward and trying to put this reflation trade on. And certainly the vaccine helped that. And the reason why we had that massive move on the Pfizer news is because that kicked in the reflation story, and the reflation trades were clear to see. We saw stocks rally, but we actually didn't see the Nasdaq rally. The tech stocks fell, and this is because people were selling their growth stocks for value stocks. You know, the things that were going to come back into play: airlines, hospitals, sort of healthcare. Hotels, all those things started doing very well again, and that rotation was away from what had been driving equity markets higher in the first place. So the reflation trade is almost a global thing. So, you know, we saw all markets lifted. It wasn't as though like in the old days when we saw, you know, reflation building in the US but not in Europe or not in the UK and not in somewhere else. And obviously, you know, US assets did well on their own. We saw all boats lifted by this because it is a global pandemic.
Okay, great. And we have a question on the FTSE. And I think you mentioned this about in the Brexit slides as well, that the FTSE 100 obviously being international stocks. Does sterling have, you know, or cable have sterling against the dollar have an impact on how the FTSE 100 moves going forward? So a strong sterling can hurt the FTSE?
Absolutely, and you know, my preferred choice in the FTSE over the next 5 years is probably the FTSE 250 or 350. You know, energy. We've got a very heavy energy stroke mining structure in the FTSE 100. So those are, you know, international businesses that most of their business is done offshore. So sterling does matter to them, which is why you often see the FTSE underperform when the sterling's doing well. But below that, I think the 250 and 350 is where the value is over the next 5 years. And I think that's what asset managers may actually look at as well, and some of the insurance companies and people like that may be in the 150, in the 100. But I think most of them sit below that. And I think realistically, with fossil fuels and the way that changes are coming with environmental and green climate issues, then I think those companies may struggle a little bit. So I think the value might be further down the food chain, if you like.
All right, brilliant. Oh yeah, who's that? Roger?
Yeah, just me listening to the last few questions really, and I think, you know, they're all interlinked. You know, good questions because it shows people are asking the right questions. But you know, one of the key things that I get out of it is always understanding what are the key drivers of the market or the markets that you're in, because they can differ. You know, and sometimes if you're focused on the wrong driver, you'll be misinterpreting the market, and that's, you know, without timing issues. So, you know, really taking your time to understand what is driving markets at the moment. And if all of a sudden you start seeing things respond differently, is there something else driving the market? You know, so certainly when the person asked a question about emerging markets and, you know, outside of G10, those are very idiosyncratic currency pairs or currencies, you know, which means, as Mo said, you need to do a lot of read and research into them to understand what makes them tick. Because if all of a sudden you're trading those off the back of a global kind of response to what's going on, but then all of a sudden an idiosyncratic driver comes into that marketplace that you're not aware of, it can hurt you. So you always have to understand what's driving your market. And, you know, great point there. You may all of a sudden find that the FTSE is underperforming, and it's because cable's going up. And if you don't understand all that and understand that that's a key driver of that product that you're in, you're going to come a cropper. You know, the fact that the yen can, at times, as it was last week, be directly correlated to interest rates, and certainly US interest rates, which may mean that broke the cycle for a week, but it seems like it's catching up. So I think it's very, very important to understand the drivers of, you know, the big picture as well as the products that you're in.
That's a good thing. In the other webinars, we will talk about what you're talking about there, which is correlated markets, where, you know, the impact of, say, sterling going up obviously pressures the FTSE the other way. So, and the same with bonds and the yen as well. So we will get onto those in the other webinars to hopefully upskill your knowledge in those areas. So on that note, thank you to everyone for attending, and also for the great questions. Thank you to the mentors. We'll leave it there. Have a great trading week ahead, and we look forward to talking to you more next week.